What's up, everybody? One moment. We are going to begin in 1 second. All right. Well, this is probably going to be played for people recorded. This is live right now, but we had trouble going live on our Financial Fusion page. So it'll be posted there later. But I want to thank anyone who is watching this, whether you are watching it as a pre-recorded video or you are watching it live. What we wanted to do was bring together experts in the areas of building your wealth and protecting your wealth. It's a very extremely important part of your planning process because the two go hand in hand together. So we have four speakers today, and the first speaker is going to be Mr. Wesley Oliver. He's a seasoned mortgage broker with 15 years of experience, offering a wide range of loan programs tailored to diverse clients' needs. He's highly rated with 100 plus five-star reviews on Zillow, reflecting his commitment to clear guidance, trust, and results. And he is my personal mortgage broker. So, Wes, you're up.
Thank you, Melissa. Let me share my screen really quick. As a mortgage broker, I wanted to talk about, just basically the role of wealth building in real estate throughout, your life and how it can set you up and continue to work for you and help you accrue wealth and maintain your current status as well. So let's start here with some key considerations in homeownership. First and foremost, homeownership for a lot of people is going to be the first major wealth building step. It's one of the largest assets you're ever gonna purchase, and it is one of the assets that can actually produce wealth for you. If you're renting, you're only building someone else's wealth. Also, ownership builds equity as payments are made over time. We'll talk about that a little more in detail. Your mortgage balance goes down over time, which is a positive thing. Historically, here in California, property values increase 3 to 5% annually. And homeownership also creates a sort of a forced savings account through equity growth and mortgage payments. So in terms of benefits of homeownership, you have the stability in housing cost over time, right? Because your rent typically is going to go up year over year. If you have a fixed rate mortgage, that's not going to be a problem. It often creates tax advantages because many of the things that are part of your mortgage that you pay every month are tax deductible in a lot of cases. So when we talk about the interest that you pay on your mortgage, as well as your property taxes, when you refinance or finance a property, some of those closing costs are tax deductible, as well as mortgage insurance as well if you do have private mortgage insurance. It is protection against rising rents. So as we discussed, rents go up year over year for the most part. If you have a fixed rate mortgage, that's not going to be an issue for you. It's a long-term wealth building application through appreciation over time. It's a strategic financial decision. It's not just a lifestyle choice. And it can set the stage for a lot of other forms of investments throughout your life. So wealth building through real estate really looks like this. Number one, you have appreciation. Over time, property values generally increase. A $500,000 home that appreciates to a value of $700,000 generates $200,000 in wealth, essentially. You also have the equity growth. So each mortgage payment reduces your loan balance. At the start of a loan, not as much, but as time goes on, more and more of your mortgage payment will go toward the principal, and it'll reduce your principal balance, which that increases your ownership percentage over time. So if you have a home loan that starts at 500,000 and over time you pay it down to 350,000, you've created 150,000 in equity for yourself. Also cash flow. So if you have investment properties, you can generate monthly income, which is passive income, right? And then lastly, you can leverage real estate, which allows you to control a large asset that increases in value with a relatively small investment. So if you invested $25,000 on a $500,000 property, which is a standard 5% down payment, even if that property increases just to a value of 550,000, you've doubled your investment. And very few investment opportunities or vehicles are going to allow you to do that. And also you can leverage your real estate for maintenance of your lifestyle. So home equity loans, or what we call HE loans, allow you to borrow against equity in times of need. You can also have a rental conversion. So you can add in ADU and start making that produce income for you on the property, or you could rent rooms out if you wanted to do that. Through downsizing over time, many people are going to buy larger homes because they have families, and as they become empty nesters, that allows you the opportunity to sell that property, walk away with a sizable amount of money, and then also downsize your living situation, which reduces your overall cost every month. Over time, you'll eventually pay off your mortgage as long as you're not consistently, refinancing it, which will remove the largest debt that you have, or the largest consideration that goes against your income every month, at a time when most people are going to have income that is no longer dynamic. It's going to be static as people go into retirement. And then also, if you are taking advantage of reverse mortgages, that's another product that will allow you to basically create cash flow for yourself and get rid of your monthly payment, which is your mortgage payment, which is your largest expense on the monthly basis. So these are all the different ways as we move through life that real estate can work for us and help not only generate wealth and of course income, but also help us maintain our lifestyle. So hopefully that was good information for you and something that you can apply to your life at some point in the future if you're not already. And Melissa, I will pass it back to you.
All right, thank you, Wes. A lot of great information there. And as you know, the cost of housing has gone up quite a bit from when, at least us here, when we were younger. So it's great to have experts on your team. And I'm going to be going next. What I'm going to be talking about is the opposite side. So Wes was talking about building your wealth, and I'm going to be talking about protecting your wealth. So protecting your wealth is extremely important. I cannot tell you how many times I have seen people procrastinate and not protect their wealth, and things happen because we don't expect for anything to happen. We expect to just live long, healthy lives, and then one day we will just pass away really late in our lives in our sleep, right? But that's not how life works. So the first thing I'm going to be talking to you about is life insurance. So when you buy that home, it's really important that you take a look at life insurance. So it's pretty simple concept. Life insurance is going to, whatever dollar amount you buy is going, something should happen to you, it's going to pay that amount to your beneficiaries. So let's just say, for example, a husband and a wife, they purchase a home together. And let's just say that one of them is income producing and the other one is a stay-at-home parent. And forget about the kids for now. Let's just talk about if something happened to the breadwinner, how is the other one that's left going to pay for that mortgage, let alone all of the other expenses? Now let's put kids into the mix. Now you've got these kids, you were a stay-at-home parent, and now you're going to have to scramble to find out how are you going to make these payments. A lot of people put GoFundMe's out there, and a lot of times their friends do it because they weren't prepared. The last thing you want when a tragedy happens is to now have to scramble, to now be worried about money. At least if you knew you had a chunk of money to replace that income, at least it would make that part of it a little bit better. So I've seen people procrastinate on this. One of my really good friends procrastinated on this and passed away at a very young age. So I've seen it across the board all over the place. So with that being said, There are several types of life insurance, but if you are just securing yourself for that time period that is really critical, so maybe it's that time period where your kids are young or you just purchased the home and the mortgage is pretty high, if you're in that state of mind, you just get a term insurance. It's cheap. It's basically like renting your home. When you rent a home, you have a lease on it. So with a term policy, you have like a 20-year lease. When that term comes up, you can keep the policy usually most of the time, but the price is going to go sky high. So usually it's better to get another policy, but you don't know if you're going to be healthy at that point. You may have some medical conditions pop up. There's a lot of new things going on in this world that people are trying out. Never know what's going to happen later on. So just keep that in mind. You never know what your health is going to be like later on. For people that have employer life insurance policies, keep in mind, usually they are one times your earnings, maybe two, maybe three, but usually they are not enough to cover those needs should something arise. So also, if you leave that company, you may no longer have that policy, and now you may be too old to get it, or maybe now you had some type of medical issue come up that you now can't get life insurance. So I always recommend that if you have a policy through your company and that's what you're relying on, I always recommend that you just get your own. It's really super cheap, especially if you're young. The younger you are, the cheaper it is. So I just highly recommend that. And I consider the employer ones a bonus and an extra should something happen. I'm going to flip over to long-term care insurance. This is kind of like disability insurance in retirement. What is disability insurance? If you can't work anymore, how are you going to make your money? So that's what disability insurance is. It just covers you should you no longer be able to work. Will your state pay? Possibly, but it's very difficult to get and takes quite some time. So long-term care insurance is basically like disability insurance, but when you are retired. So this comes down, you've bought that home, maybe you have some rental properties, maybe you have your retirement savings, you've gotten to that point in your life where yay, you can retire. Maybe you still work because you love it, but you don't have to work. So what I call retirement is financial independence. When you get to that place in your life that you can work if you want, but if you choose not to, you have that ability. So with that being said, imagine again, if you're married and your spouse all of a sudden comes down with dementia. You see it slowly coming, and then it just gets quicker and quicker and a little bit more aggressive. And you are trying to take care of your spouse, but there comes a time and a place where you can't anymore. So now you need someone to come in and help you. Maybe at some point you're going to have to send that spouse to a facility. When that happens, that's where I see a lot of financial ruin, if not planned. If planned, it's amazing. But if you don't plan, I see people having to go back to work. I see people, again, with the GoFundMe's, I see people struggling. I see people's anxiety go through the roof because they have now eight to $15,000, and this is not exaggerating on the cost. It just depends on where you live and what type of facility you go into, but it's 8 to 15 grand in 1 month. So imagine you are living and you're retired, and then all of a sudden you have this ginormous expense, and inflation on that is large. So if you don't plan for it, it's going to come from somewhere. I have a lot of people saying, well, Medicaid will pay for it. Sure, they will. But again, you're going to have to spend down all of your hard worked assets. You will not be able to leave anything to your children, and that could have all been avoided. And some people, honestly, they don't care to leave anything to their children. But for those that do, there's a smarter way to do this, is my point. So I'm going to leave it at that. If anyone wants any more detailed information, as a certified financial planner, I have to recommend long-term care insurance to all of my clients. That is how important it is. And if I do not recommend it to them and they don't sign a waiver that they decided that they do not want to proceed with it, or I don't have any proof that I did share this information with them, I could lose my CFP, and probably a lot more than that. So that is why I'm telling you, it is super important just to take a look at for yourself. The sweet spot, by the way, of when you start looking and maybe really considering this is between 55 and 65, because at that point, maybe kids may be out of college. You're now thinking, wow, I'm really getting closer to retirement. And, I am getting old. My body's starting to hurt. You really just, everything gets into perspective. You are no longer a 15, 20-year-old that is invincible. You now see that life is happening. So I'm going to leave you with that today. And at this point, I'm going to introduce our next speaker. So our next speaker is Stephanie Stansel. She's a Southern California real estate professional with a client-first, strategy-driven approach. She is passionate about helping families make informed, confident real estate decisions. Stephanie, you're up.
Hey, good afternoon. I just want to make sure that my screen is showing what I wanted to show. And so again, today I'm Stephanie Stansel. I'm a realtor here in Southern California. I specialize in helping seniors and families make really smart housing decisions and wealth decisions. I support lifestyle and we support legacy. Today's conversation is about senior solutions and what it's really about. It's basically about one thing, making confident, informed decisions about home and equity and the next chapter of life. As we move through the presentation, we'll talk about what's happening in the senior housing market right now, where most health is being held, why planning gives us options, and how to make decisions to protect independence and legacy. My goal is real simple here today. It's to give you clarity, give you options and peace of mind, whether to move, whether the move is happening now or just not even at all. So let's go ahead and get started. So next slide, Stephanie. The demographics, 10,000 Americans turn 65 every single day. That's a lot, right? By 2023, all baby boomers will be about 65 years old or 65 plus. 1 in 5 Americans will be at retirement age by 2030. 80% of senior wealth is in the home. And that's huge because Wesley talked about mortgages. He talked about the reverse mortgage. Melissa talked about protecting it. So with that, 80% of their wealth is sitting in their home. And 90% of seniors want to age in place. And so with that being said, we need to help them with the data. So equity data. Home equity is the largest asset for most seniors. Average homeowner has been in their home. It says 40 plus, but the numbers numbers are between 20 and 40 years. That's a long time. So there's lots of equity unless they refinanced or did something different. The average homeowner has 40 or more 40 times the amount of wealth as a renter. And then seniors hold trillions in home equity nationwide. Property taxes and maintenance often is the biggest retirement expenses. And again, Wesley did mention a reverse mortgage, and that kind of plays in that sometimes too. As far as downsizing and transition data, 51% of the seniors plan to move at least once in retirement. So sometimes that could be some type of care facility. It could be somewhere with the children, or it could be the children moving in and out. So there's all those options. It's the top reasons for the transition is maintenance, cost, healthcare. Again, Melissa talked about healthcare and cost of healthcare and lifestyle. And then from there, most wait too long and feel forced to make quick decisions. So again, that's one of the reasons why we're here, is to offer options for our everyone. But I'm focused more on the seniors because with the insurance and with the reverse mortgages and different options with mortgages, it gives them an option to make decisions and they're not rash. The last thing we want is a senior that is older in age, has health issues, and they have to make a decision about a home and then not sure how the children play. And then early planning creates more financial choices. So plan early, you got more options. Wait too long, you have fewer options. With that, our checklist is the financial and lifestyle concerns. The biggest concerns is they outlive their savings. A lot of folks live their whole life, they work their whole lives, and they want to make sure that they can outlive their savings. Rising health care costs. Again, we're here in the United States. Health care is something that we are always very concerned with. Are we going to be able to be healthy and have what we need as far as going to the doctors or medication? You hear stories about some medications are $100 a pill. And so we want to make sure that they're all able to check that box. Maintaining independence, which is huge. After you've lived a whole life and you get to be older in age, you want to be independent. And then leaving a legacy. Melissa talked about sometimes they're not even able to leave a legacy because they're trying to live. And if life happens and they don't have a life insurance policy or other options as far as their mortgage, sometimes they can't leave their children anything. And then also avoiding scams. So again, if there's planning involved, they can kind of avoid the scams. Next thing, just some data here in Orange County. The 55 and over market prices range anywhere from 350,000 to $1 million. It's a big range, but again, you have to look at Orange County as a very diverse real estate market. Yes, there are some smaller numbers, but the average home price in Orange County is about $1 million. And again, as it says, depending on property and location, demand is still very strong with limited inventory. Yes, the market is shifting, things are sitting a little longer, but single story properties are requested and they don't move as they don't come on the market as often. Market time is sitting about 20 to 40 days if it's priced properly. And then why would they move? Simple life, reduced maintenance, community living. And then the HOA cost is another factor, anywhere from $300 to $700 a month. And then there's taxes based on purchase price. So with that, I'm wrapping up. Most of the wealth seniors have is tied to real estate. My role here today is to help you make a wise housing decision that protects your lifestyle and your legacy. Again, Stephanie Stansel, thank you. Next time, we're going to talk about senior housing and wealth realty. Thanks, guys.
Awesome.
Done.
Thank you so much. That was a great presentation. You had a lot of helpful and great information. Next up, we have Leah Bergman. So Leah Bergman is a Social Security advisor, certificate holder, and Medicare consultant with Easy Day Insurance Services. She specializes in making Medicare and Social Security easy to understand, guiding clients in both English and Spanish. And I didn't know that, so I learned something new today, to make confident choices about their benefits. Let's go, Leah.
All right, you guys, I'm trying to share my screen. Give me just one moment. Here we go, getting that going. Are you guys able to see my screen now?
We see something. Yes, there we go.
Okay. So I'm Leah Bergman. Well, while this is going up, I'll start. Well, the great thing about me following Stephanie is I have some great information on how selling your house affects your Medicare, which I'm going to discuss with you guys at the end of my presentation. So stay tuned for that. But in the meantime, we're going to talk about Social Security and how you can maximize that. Whoopsie here. I had this all prepared, but it looks like it doesn't want to work with me. Give me just a minute. I apologize for that. Okay, there I am. So basically, I want to talk about don't leave your money on the table and how to maximize this. And I'm Leah Bergman with Easy Day Insurance Services. And as she told you, I am a Medicare insurance consultant. So what does that mean? I help people through the maze of Medicare. And basically, you get an expert for no cost because I get paid with whatever insurance services you choose. And I'm also a National Social Security Advisor certificate holder. So first, let's start. What age do you think retirement Social Security benefits are available? So what is anybody's guess? You think it's 60, 62, or 65? I'll wait for everybody to put it into the chat and see what you think. All right. Well, it is 62. It is 62. That is when your benefits first are available to you. But does that mean you should take it at that time? Let's look into that. So your choice of when and how to file for benefits can have a significant impact on how much is guaranteed your lifelong income you and your spouse will receive through your retirement. So look, I want you to look at this chart right here. And if you look at your year of birth, you can see when your full retirement age. And we're going to talk about what that means. Because your first can take your retirement at 62, but your full retirement age depends on when you were born. So 1960 to present, that's 67. And you can see here, so that's where we're at. The people that are now turning 65 are born after 67. So you can't take it into your full retirement age until you're 67. And then if you decide to defer it until 70, then you get some extra bonus added. So what does that mean? Well, I do have a chart that's going to show you how much is decreased, because you're not going to get your full retirement at 62%, but it depends on the case that you have. Sometimes people choose to take it at that time because they're seeing the benefit and waiting is not going to be worth it for them. And then if you're married, here's how it works. One of the spouse, if you're making less than your husband. So let me take an example. Let's just say the husband makes $2,000 in retirement, but the wife only makes $500 in retirement. So can take up to half of his. So what does that mean? That means that he makes $2,000, so she gets $1,000. So they will add an extra $500 to match her up to $1,000. You're not getting $500 plus the $1,000. You're getting up to that half. And so and she can't file and get that until he files. But some couples decide maybe he should wait till 70 to take it so that she can get that full amount. So it kind of depends on your personal situation and how much it is on each level. So, and one other thing I wanted to talk about protecting it. If you are still working and you are not at your full retirement age. Now remember, so people who are now turning 65, that's not until 67 years old. If you decide to still work and you take your Social Security, you can only make up to $23,400, and then they are going to withhold $1 for every $2 over that annual limit. So let's say you make $50,000, right? They're withholding, let me do the math real quick, over $27,000 or $26,000, one for every two over the annual limit. They are withholding that amount. And then once you reach the full retirement age, then they're not going to withhold anything. So this is very important information to know, because some people decide to take it at 62, but they're still working and they're going to lose out on a lot of that income. So, and here's the chart that I was telling you about. When you are 62, you will receive 70%, okay, of what you get, and it goes up every year. And this is based on this is based on someone that is older than just now turning 65, because their full retirement age is at 66 and 10 months. So you can see if you take it at 62, you would get $1,400 versus in your full retirement age at $2,000. So you are missing out on about $600 per month. But it really depends on your situation. Some people can't wait and they need to take that right now. And other people decide to wait. Or so really you need to confer with your financial planner to find out when that will work for you. All right, so let's move on here. And now I wanted to talk about, remember I told you that at the end I was going to talk to you about what Stacy mentioned about selling your home when you're 65. But I wanted to bring out a very important point here. So in 2026, the average person will pay $202.90 for Medicare every month. And it doesn't go by couples. This is each individual person will pay $202.90. All right, that's the average person. So let's take someone that's filing jointly. If you're filing jointly, it will be $218,000 or less. You will pay $202.90. So keep in mind, they are looking 2 years in the past at your tax return. And so they're looking at 2024. And this is not your gross. This is your adjusted modified income. So when you look on there and you take all your deductions, this is that amount. Okay. So if you are making less than 218 joint with your spouse, or if you file individually 109, then you'll pay 202.90. And then you can see as the income amounts increase, you're going to be paying more till finally we get to 750K or above, and it's 689.90. So why does this matter? Well, this matters obviously because you're paying more, but why am I bringing this up with to do with real estate? So if you sell your home, and the average home, like we were talking about, could be, I know, in some areas in Orange County, you can't get a home for less than $1.1 million, then guess what that's going to put you at? Because any of your time it goes into your capital gains, it affects your income, and it's going to pop you up here. And now for Medicare, you are paying $689.90 a month. So this has happened to some of my clients where all of a sudden they were paying $202.90 and now they're jumped up here to pay $689.90, and they're counting on this money because this is their retirement money. They sold their house and this is their retirement money. And so why am I bringing this up? You should discuss this with your financial planner. Anything that's going to raise your capital gains up is going to increase your costs significantly for Medicare. So thank you very much. I'm so happy to be able to talk to you about this. If you have any questions about Medicare or Social Security, go ahead. Here's my information on the screen, and I would love to speak with you.
Thank you, everybody. You all did a great job. I hope you all out there have learned a thing or two. But if you did want to reach out to any of us, we will put our contact information in. But thank you for taking your time to watch this. Please share this across social media, like our pages, and have a good afternoon.